Did you know? According to a survey conducted by Lloyds Bank, 38% of British people say they find jargon related to money baffling. This statistic highlights a clear gap in financial literacy and proves action is urgently needed. When entering the world of personal finance, it is very easy to find yourself overwhelmed with the vocabulary that is often used. However, the importance of financial education cannot be argued in your pursuit to build wealth. In this video, I will be explaining basic terms that you must understand if you want to take control of your money. I have scoured multiple websites, banking applications, and finance articles to put together a list of terms that appear regularly to make it easier for you to get to grips with the terminology necessary to start your wealth building journey. First things first, a current account. In the UK, a current account is used for everyday banking. This includes managing your income, paying bills, setting up regular payments, which can be known as direct debits or standing orders, paying for goods and services, or withdrawing cash. When you start looking into finance, you may come across the term checking account. This is more widely adopted in the US, but it means the same thing. Normally with a current account, you will receive a debit card and you will need a PIN number to use this. There are variations of debit cards and current accounts, but for the time being, you should just know that in general, they are commonly used for day-to-day spending. You only have access to what is in the account at that given time, and this means that you normally won't go into debt when using a debit card. A loan is defined as an agreement to borrow or lend something. This applies to many things, for example in football. Yes, football, not soccer. A player can be loaned to another team. The player still belongs to the team they are contracted to, but they can still play for another team for an agreed length of time before they are returned to their original club. The same is true in finance. For example, a bank can loan you money, but it technically still belongs to them. At some point in time, you will pay the money back in full. This could be in one lump sum or spread out over multiple payments. There are many examples of loans in finance. One example is an overdraft. If you spend all of your money in your account and enter your overdraft, you are essentially borrowing money. Another common loan is a mortgage. This is what home buyers generally use to pay for a house. These are normally large sums of money which can be borrowed and the customer spends years paying off the loan. Other examples include car, student or business loans. You must be thinking, wow, it really is generous for these banks to allow people to borrow money out of the kindness of the heart. Well, unfortunately for the lenders, there's a reason why banks are so keen to lend their money. And this brings us nicely onto interest rates. This is the price someone pays when they borrow money. When an amount of money is borrowed, it is a common requirement to pay back the full value plus interest. The bank is essentially doing you a favour by giving you a lump sum, so they ask for a charge to compensate for this. At the time of recording, the average salary in the UK is £35,830 before tax. At the same time, the average house price is now nearly 300 grand. Taking this into account makes it easy to understand why someone would be willing to take out a mortgage and pay it monthly. However, this comes at a cost. Throughout the full loan duration, a person could pay a large amount of interest. A credit card is another form of card someone can use to pay for goods and services, however they work in a slightly different way. When someone starts using a credit card, they will initially agree on something called a credit limit. This is the maximum amount of money which can be spent on a credit card, which must be paid at a later date. Credit cards are a form of borrowing, so any balance which is not paid off in full at the end of each month is charged interest. Depending on the service, this amount can be very high. At present, the average rate in the UK is sitting at around 25%. This is huge and can lead to a build-up of debt very fast if not dealt with properly. There are some positives with using credit cards though, as they generally use reasonably good rewards to entice people to use their services. This can be points, which can be exchanged for things like airline miles, or they can even offer cashback. Cashback is when you receive some amount of money in return for using that specific card. Again, think of it like a reward for using their services. Seems pretty cool. Of course, they have to rope you in somehow. Just bear in mind that in order for this to be worth it at all, the balance must be paid off by the end of the month, otherwise the fees will completely eat up your returns. It doesn't matter how good the credit card rewards may seem, if you're paying 25% in interest, it will not be worth it. Savings are defined as any money you put away to use again in future. This could be for something you'll want to buy, like a car, a holiday, tickets to see your favourite band. Normally people spend all of the money they get and see what they have left over at the end of the month and save. But it can be a good habit to reverse this process and put money into savings immediately once you've been paid. There are many habits and methods to improve savings, and I will spend a lot of time talking about this on the channel. There are also different places to park your savings once you've got your hands on that extra cash. One method which people might use is storing the cash under their mattress. Holding cash like this has various pros and cons, but is generally not considered to be a good option due to things like security and inflation. Inflation is where the value of money depreciates or goes down over time. Every year you keep that stash of cash hidden in your home, it costs you more money in the long run. There are multiple products which allow you to save money, such as a savings account at a bank. These come in different forms and the user must decide how easy they want their funds to be accessed, whether they will need them immediately or they can afford to wait for a period of time when they need them. This is the difference between regular saving and fixed term savings. Another method is with an HYSA or an individual savings account. These come in varying methods, but the main distinguishing fact is that your earnings from an HYSA are not subject to tax. HYSA. This is a common term which is found when researching finance. Simply put, it stands for High Yield Savings Account and just means you would expect a bit more interest compared to other savings accounts. These accounts are a great example of showing when interest rates are working in your favour, something which you need to happen if you're planning on building wealth. Emergency fund. Building from all this talk about savings, an emergency fund is a common term that refers to the amount of money saved up by an individual. Usually, the generic guidance is to have 3 to 6 months of expenses put to one side. A person would calculate their required amount by working out their expenses for 1 month and multiplying this by the selected number of months, whether that is 3 or 6 or otherwise. Emergency funds are extremely important because they're a buffer between yourself and this mysterious thing called life. You can guarantee that if you're not prepared, an unexpected cost will appear, setting you back in your journey. With an emergency fund, you can relax that little bit more, knowing that if your car breaks down, your roof caves in, or if your pet needs medical aid, you are covered and you can divert your attention to the more pertinent aspects in your life. An investment is anything an individual purchases with the hopes of earning money. This could be from an asset which appreciates or goes up in value, such as a stock, a property, or even collectibles. During the study mentioned at the start of the video, it was discovered that many people didn't invest because they were scared of losing money. This is completely rational, as there is no guarantee you will earn money from investments, and they could actually go down in value. There are a massive range of investments, and they make up a spectrum with varying time horizons and risk potential. Again, someone looking to invest must decide on what to go for based on their own circumstances. In summary, tax is paid on money you earn. The money is utilised by the government to benefit society. Here in the UK, the National Health Service is pretty much fully funded by taxes and national insurance payments, meaning everyone has access to free healthcare. There are many things the government spends the money on, which are ideally focused on benefiting the society in question. The amount of tax which you pay depends firstly on the country you reside in. It is different from most countries. In the UK, the amount of tax you pay also changes depending on the amount of money you earn. Earning more money puts you into a higher tax bracket, meaning more of your overall salary is taken. It must be noted, this is a mandatory expense. In conclusion, we have covered some popular terms which must be understood if you want to make progress on your learning experience. Although they're not the most exciting, these foundations are absolutely crucial to identify if you want to build wealth. I'm sure everyone watching can tell, but this is my first ever YouTube video, so this is a massive milestone for myself. I can't imagine there'll be many, but if anyone sees this video, could I ask that you get involved and leave a comment with regards to what we've covered? Are there any other topics you think would be relevant that you struggle with? Any further suggestions or even feedback would be really appreciated. Thank you for watching. I will be exploring each of these topics in greater detail in future, and I'll hope to see you then.